Most financial media will tell you Iran and the Putin-Xi summit are separate stories. They are not. They are two sides of the same strategic realignment, and together they tell you where oil is headed. Welcome back to Market Lens. I'm Daniel Reed. It is Wednesday, May 20, 2026. Let me give you the two headlines the mainstream is not connecting. First, President Trump called off a strike on Iran Monday. Vice President Vance says, "We think we've made a lot of progress." But Trump also gave Iran a deadline, 2 or 3 days, maybe Friday, Saturday, Sunday. If no deal, we may have to give them another big hit. Second, Vladimir Putin arrived in Beijing yesterday for a state visit with Xi Jinping, walking the same red carpet Trump walked just 5 days ago. More than 20 agreements signed. Power of Siberia 2 pipeline gets the green light. These two stories are linked by a single thread: energy. And the connections between them tell you more about where oil is going than any analyst forecast. The Iran story is being framed as progress toward peace. That is misleading. President Trump's whiplash, calling off a strike, then threatening another one days later, is not chaos. It is a deliberate negotiating strategy. Each day, oil traders have to price a binary outcome, either a deal that crashes crude to $90 or a strike that sends it to $125. Brent settled at 111 yesterday. WTI at 107. The fact that oil barely moved on the strike called off headline tells you the market has already priced this dynamic in. Here is what the mainstream misses. Iran is not negotiating from a position of weakness. The Strait of Hormuz remains effectively closed. The IEA says more than 80 energy facilities have been damaged. Recovery could take 2 years. Iran's latest proposal calls for ending hostilities on all fronts, including Lebanon, and U.S. withdrawal from areas close to Iran. They are using the Hormuz blockade as leverage, and it is working. The wild card that almost no one is discussing. NATO is now considering escorting ships through the strait if it is not reopened by early July. That would break the bottleneck without requiring a diplomatic deal. But it also risks direct NATO-Iran military engagement, a scenario that would take oil far above $125. The base case is continued grinding uncertainty. Oil stays above $100, inflation stays sticky, and the financial conditions that depend on cheap energy remain under pressure. Now to Beijing, where the more consequential story is unfolding. Putin arrived in China yesterday for the second major state visit in a week, following Donald Trump. The timing is deliberate. China is positioning itself as the indispensable power, the only country that can host both the American and Russian leaders within the same week. The Global Times called it extremely rare in the post-Cold War era. What came out of the summit? More than 20 agreements on trade, technology, and AI cooperation, a renewal of the 2001 Friendship Treaty, and a joint declaration on what they call a multipolar world order. But the headline for markets is energy. Putin confirmed that Russia and China reached a general understanding on the Power of Siberia 2 gas pipeline. This is a multi-billion-dollar project that would send Russian gas to China for decades, exactly as Europe has cut itself off from Russian supply. Here is the logic the mainstream media is not explaining. China locks in discounted energy from Russia at a time when the Strait of Hormuz is blocked and Persian Gulf supply is disrupted. Russia locks in a permanent buyer when European markets are permanently closed. This is the Sino-Russian energy axis, and it is the most significant energy realignment since the formation of OPEC. For markets, the implication is direct. This deal reduces China's incentive to push for a quick resolution to the Iran standoff. China now has a backup energy source. The diplomatic pressure on Tehran weakens. The conflict grinds on longer. Most analysis treats the Iran standoff and the Russia-China alignment as separate geopolitical stories. They are not. They form a single structural shift, the fragmentation of global energy markets. Here is what changes. First, the oil normalization thesis is dead in the short term. A quick Iran deal that crashes oil to $80 requires China and Russia to pressure Tehran. They now have less incentive to do so. The energy axis makes prolonged disruption more likely, not less. Second, the global economy is splitting into blocks. The US-Europe bloc is energy constrained, reliant on unstable supply routes, and facing persistent inflation from energy costs. The China-Russia bloc is building a self-contained energy system. Russian gas, Chinese manufacturing, bypassing dollar-denominated markets entirely. Third, the NATO escort wildcard. If NATO begins escorting ships through Hormuz by July, that is the single most bullish catalyst for risk assets. But it carries a 15% probability of direct military engagement with Iran. Markets are not pricing that tail risk. The trade for this environment? Own energy infrastructure and defense AI. Own hard assets that are priced in dollars but sourced independently of the Hormuz choke point. U.S. natural gas, domestic energy producers, and utility companies with regulated generation are insulated from this dynamic. The playbook from our fragile pause framework still holds. This is a resource-driven market now. The countries and companies that own scarce energy supply set the terms. The Iran paradox and the Putin-Xi summit are different headlines, but they tell one story. The world is resorting itself along energy lines. American strategy relies on pressuring Iran back to the table. Russian strategy relies on locking in Chinese demand before any deal is signed. Chinese strategy relies on playing both sides, hosting Trump and Putin in the same week, securing energy from both Russia and any eventual Iran resolution. The market wants certainty. It is not going to get it. The Strait of Hormuz remains the most important choke point in the global economy, and the diplomatic machinery to reopen it is weaker today than it was a month ago. Because the Russia-China energy deal gives Beijing less reason to push for peace. NVIDIA reports tonight, and that will be the headline tomorrow. But do not let the earnings distraction pull your focus from the structural story. The energy axis is being forged in real time, and it will define inflation, Fed policy, and sector performance for the rest of 2026. I'm Daniel Reed, and this has been Market Lens. Stay logical.